Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will do a weekly podcast with all things real estate, from interest rates to the economy to what's happening in Washington. Anything that affects your real estate will be covered here. Like I said, we're not a traditional real estate show where we're basically going to tell you each and every week why it's such a great time to buy. Now, while I do believe that it's a fantastic time to buy based upon a low interest rate environment, you know, being able to protect yourself from future inflation, locking in at low fixed rates, I mean, that's the primary basis for my claim to why it's a fantastic time to buy. Others will tell you that, you know, oh, look, we have price appreciation, and that's what makes it a good time to buy. And while if you're an investor, that makes a lot of sense if you're buying and flipping. I know a lot of investors at this point in time are a little befuddled because they can't figure out quite what's going on with the market. And, you know, we're going to kind of jump into the dynamics of the market, what's causing these issues. We're going to talk about, obviously, the Fed. We're going to talk about, you know, the winding down of QE. Today we're going to jump into Europe and now how ECB came out and I now have negative interest rates, which is going to force money out of the banks basically to invest back into bonds and other securities, i.e., more treasuries, US Treasuries and mortgage-backed securities, whatever it may be, that's going to pay more of a yield there. So we're going to jump into that stuff. I think the big question, the talking point for today that I kind of want to dive into is how is your economy doing? I know many, you know, we hear a lot of, you know, the media talking about what's going on nationally. And obviously we understand that all markets and economies, especially in the D.C. metro area, there's a completely different dynamic taking place here versus the rest of the country. And a lot of these numbers get skewed when they factor in a lot of rural areas and areas where there's not as many jobs. So I really want to focus in on, you know, allowing you to determine how your economy is doing. I don't, you know, we're going to talk nationally a lot of the time. I'm obviously located in the D.C. metro area, so things are going a lot better here than many of the places throughout the country. But I'll let you guys be the determining factor. We're going to give you a breakdown, a lot of statistics today, as well as what's on deck as far as economic news. If you guys haven't already subscribed to the podcast, please do so. If you go to iTunes, you can search on the iTunes search bar at Real Estate 360, and you can subscribe there. You can download the podcast and all the previous podcasts there. You can also share with anybody that you may feel would get some, you know, get some of the good content that we put out there, and they'd like to have that. Joining me on our panel, as he does each and every week, is Louis Camerosano. He's a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert in Forbes, Wall Street Journal, Fox Business, US News, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you?
I'm doing well, sir. Thanks for asking. So, you know, we've had a little bit transpire over, quite a lot actually, over the last week. And, you know, we always talk about, you know, how it's always interesting when things start going, to me, really wrong with the economy. We always have these diversions that take place, such as most of the news has been completely focused on the political issues and the U.S. soldier that was basically released from Afghanistan after 5 years of captivity in exchange for us releasing 5 basically terrorists. So this has kind of been what's been, you know, center stage. This has been the main focus. So it's like we always talk about when we don't want to have to focus on, you know, one of the main issues, which is our economy, our deficit, and all these other things. We really can shift focus, shift gears really fast. And that's kind of what's taken place over the last week. But even with all that taking place, and yesterday we have the ECB that has basically came out, and they lowered their key interest rate from 0.25% down to 0.15%, but they then became the first central bank to drive rates below zero with a negative 0.1% deposit rates, which basically means that they're going to make it so that the banks have to lend out this money or invest it in other things such as bonds. I believe you wrote a blog post again this week on smoggle.com where you basically said we've been, we've been discussing this for weeks now. Where is this money coming from to be able to buy our treasuries, right? Our mortgage-backed securities. Well, by the ECB making a move like this, it obviously now makes sense why Belgium would have a lot of interest in now buying up the majority of our bonds to kind of make up, a lot of the differences for the lack of or the pullback that we've had from the Fed and the winding down of QE. Interested to get your take on the ECB here, Louis. And also, do you think now, as we suggested last week, that by the ECB doing this, that it actually strengthens the U.S.'s position as far as how they look compared to the rest of the world, to where that, our whole, kicking the can down the road, this is just going to, further that by them making this move?
Sure. Well, Ryan, what the ECB did helped. If you think about it, it's kind of strange, but the European euro is trading at a premium to the dollar, which hurts European exports. So they needed to come up with a way to get the euro price to go down, and the dollar has been kind of battered lately just from a lot of bad press and also because they're doing QE. So they need a way of strengthening the dollar because that's the world's reserve currency. It's kind of out of whack if the euro is trading at a premium to the dollar when the dollar is supposed to be the world's reserve currency. So what I suspect happened was, and Europe has also been worried about deflation, and they haven't had a QE in money printing, so they do have a lack of demand, and they have not boosted their economy in the same way the United States has done by pouring $4 trillion worth of QE into the economy to boost asset prices. So Europe does have a deflation issue, and they need to kind of devalue their currency. So what I suspect happened was they went with the negative interest rates, which for our listeners means that when banks put the reserves on deposit with the European Central Bank, they're now, instead of getting a small amount of interest or no interest, they're going to have to pay to do so, which makes it a disincentive for the banks to hold reserves in the ECB and is an encouragement for them to go out and find better uses of it, put it into the economy, and lend it out. Well, what I suspect is happening is that the European banks, while they will lend out money if they're going to lose money by having it in the bank, they're also going to still need to keep reserves somewhere, and where better place than to keep the reserves than in US Treasuries, which helps the United States out because the United States, under the Federal Reserve, was buying $85 billion a month worth of Treasuries and mortgage-backed securities, which made up 60 to 90% of the U.S. Treasury market. And you and I have questioned for over a year now, once the Fed stops buying them, who could possibly step into the shoes of the Fed, or which entity or entities could buy the amount, $40, $50 billion a month of U.S. Treasuries in order to keep the interest rates low and the bond prices high? And there's basically, you scratch your head, and if the Fed is buying 60 to 90% of the Treasuries, there is no one. Especially you have to consider when we're worried that Russia may be dumping bonds and China has stopped purchasing them. So you really need someone to pick up the pace more than the Fed is even doing during QE. Well, it makes sense that perhaps European banks now are going to hold the reserves and have already started to hold the reserves in U.S. Treasuries, front-running the fact that the European Central Bank is going to charge them. So this trick could be a coordinated ploy between the central banks where the Federal Reserve needs to stop QE. They know that QE is harming the dollar. They know that QE and excessive money printing will lose confidence in the U.S. dollar. They know that eventually it causes inflation, price inflation. It actually is inflation with an increase in the money supply. And Europe needs to lower the value of the euro and needs to stimulate its economy. So they go negative. European banks buy U.S. Treasury to keep the demand, a floor of the demand for the U.S. dollar, and they think, it's going to work out. It's just another example of the countless number of tricks they have to so-called fix the economy, when really all they're doing is just shuffling money around, and the end result of all this is you get consumer price inflation, and which hurts the average person, and you get asset price inflation, which helps the rich. Real estate and stock markets go higher, but there is no corresponding wealth effect from rising stock prices and home prices where people actually, that money turns into creating jobs and productive capacity. It just makes the value of those existing assets higher, and the people who own them get wealthier.
Yeah, and what's interesting is, we've had some, obviously, some of the economic releases this past week. So we had the ISM Manufacturing Index, which this is another joke right here, Lewis. So it comes out at 53.2 versus the estimated 55.4. So that initial reading, she is showing an expansion, but lower than expectations, which initially was positive for mortgage interest rates. So that day, mortgage interest rates got a little bit better initially, but then they basically came back and revised that number and essentially said that there was a software error.
Yeah, it's always revised upward.
Yeah, and so it went from 53.2 to 56, which is then very strong. It was a very strong reading at 56 now, and all of a sudden, mortgage interest rates got much worse on that news. So this is just it's a complete and utter joke. It's complete manipulation of these numbers. And we have non-farm payrolls that's due out today, Lewis. I promise you, if it hits like basically if it's a better number than expectations, and all the stars are perfectly aligned, especially with the ECB making that move yesterday, right. I would expect for this number to come either spot on, like so it's not good or bad, or better than expectations, because that really will allow the Fed to leverage again in their talks to say, hey, looks like we're moving in the right direction now. Looks like Europe's in a little bit of trouble, right? We're probably the best option out there compared to Europe and China and everywhere else. So these numbers are, and
it gives Europe the justification for doing what they're doing, saying, look, the United States engaged in monetary manipulation and it worked. We've got to follow their path. Ryan, look at the data that came out this week. Productivity was down 3.2%. The ADP employment data, just 179,000 jobs. The trade deficit widened. Okay, and then they hang their hat on, well, the ISM comes in bad, so they have to revise it up, and they say, oh, wait, the ISM, that everything is fine now. And all the news stories started focusing on how that was evidence of an improving economy, ignoring the widening trade deficit, ignoring the employment data, and ignoring the productivity. And what I find humorous is economists were always blaming the weather, and I was calling the economists weathermen. Well, now they're comedians. Now they just make up stuff, and they put these wild spins on it, and you're supposed to, with a straight face, and you're supposed to believe it without laughing. And when the trade deficit widened, I think this guy, Joseph Lavorgna, he's always been a big cheerleader for the economy at Deutsche Bank. When the trade balance deficit widens, he says this is due to a rise in imports, which reflects stronger Q2 consumption. Yep. Just like when he said that if we had when one of the job reports came out, there was an increase in part-time labor. And he said, well, that means there's pent-up demand for future hiring. No, it doesn't. It means that employers don't want to hire workers full-time. So they've gone from weathermen to comedian to deniers, whatever it is, Ryan. It is absurd that they will find one piece of economic data that suits them and then latch onto that and make jokes about how wonderful the economy is. And if they don't have the right data, they'll revise it. Like they did with the ISM to make everything look better.
Absolutely. And you know what the interesting thing is in the absurd part, as you mentioned, is that like before this non-farm payroll number comes out today, Reuters and all the other outlets have already written their headlines, whether it's a good number or bad number. They're going to change they're going to change one sentence in one paragraph, maybe, right? And it's going to go out however they've already positioned it. So it's going to always be positioned in a positive light. Now, you and I, we follow a lot of different other blogs and things like that, and I don't know if you saw the blog that was submitted on Zero Hedge, but half the country makes less than $27,520 a year. and the
Right.
15 other signs of the middle class is dying. I thought it was well put together as far as statistics are concerned, but these numbers are pulled from the Social Security Administration that basically 50% of the economy is earning $27,520 a year, okay? And so basically, for half the country to be doing that, they're not in a position to do much because realistically, that's about $2,000 a month. How can you pay for a mortgage, a car payment, health insurance in general would eat up a majority of that. Then you have gas,
Right.
food.
I quickly put together, Ryan, the average car payment has risen to $474 a month. So you have car sales up, but you also have them at all-time highs. So if you take $500 a month car payment, I mean, you got to add insurance on that, another $150. If you want a mortgage, $1,500 to $2,000. If you went to school, you got a student loan, that's a couple $100. You've got a health care premium for a couple $100. You're already at $3,000 a month. That's $36,000 pre-tax dollars, and you haven't eaten yet.
Right.
You haven't heated your home, and you haven't done anything else. And if you're making $27,000, there's no way you can have any of those basic amenities.
Right. I mean, and look at some of these numbers here. According to the U.S. Census Bureau, 36% of Americans under the age of 35 own a home, which is the lowest level that's ever been measured.
Can't afford it.
Right now, approximately 1 out of every 6 men in the United States that are in their prime working years between 25 and 54 don't have a job. The labor force participation rate for Americans from the age of 25 to 29 has fallen to an all-time record low. The number of working-age Americans that are not employed has increased by 27 million since the year 2000. According to the government's own numbers, about 20% of the families in the entire country do not have a single member that is employed at this point. 25% of all American adults do not even have a single penny saved up for retirement. Now, these are not, I'm not throwing these things out there here to scare people, but this is just the reality. Now, the reality is, and what I started at the top of the show with, how is your economy doing? And that question is because it really is important to look at your overall situation, your own economy. And we can talk a lot about what's taking place nationally because these are national numbers that are thrown in here. And areas that are metropolitan, such as D.C., such as New York City, San Francisco, these are going to be the outliers. They're going to be the ones where there might be only, 25% of the population is affected this way versus 50% nationally. So I don't want to make it seem like, people around here aren't doing well, but I promise you, if you talk to the average Joe, they'll still tell you that they don't have as much money now as they did. Rising healthcare costs, rising food costs, and energy costs as far as gas. All these things are putting the pinch on everybody. And even if they're not willing to admit it, it's happening. This is the truth. I mean, I'll give you another example. The MacArthur Foundation found that more than 2 in 5 adults believe the housing market continues to be a serious problem. While economists and housing experts say the housing crisis is behind us, large proportions of the American people are not feeling the relief. And a large proportion of the public continues to believe that we're still in the midst of a housing crisis and the worst is yet to come. So what you're saying, Ryan, is, and you use the term eye test, it doesn't take an economist to tell you that things are not going well. But the economists are telling us things are going well, and they would go even better if we can just get some inflation. Well, that's wonderful. If you can't afford stuff now, we need a little more inflation to make it even harder for people to afford stuff. Because somehow if prices rise, consumption will rise, demand will rise, and the economy will do better and create jobs. No, if we have inflation even more than we have it now, people will buy even less because they can't even afford to buy the basic necessities today. Absolutely. I mean, you're talking like instead of gas being at $4 a gallon, and
get it to $5.
It might be $7 or $8. You know what?
Let's get house prices even higher so you can't afford them.
Right, and then
let's make food more expensive because that's a sign of a healthy economy.
Right, people can't afford to eat, which we already have about 49 million Americans that are basically dealing with food insecurity right now. So let's make food prices higher. Let's make gas higher so people can't even afford to get to their jobs.
Right.
I mean, we have huge issues, and the way that we're dealing with them right now is to just basically turn a blind eye and act like everything's okay. We've been doing this.
And you're right about how they'll have their story ready to go on this non-job first of all, they probably already know the number. It's probably been released to them. But they have their stories ready. So, for example, with the initial jobless claim, when that comes out, if it's going to be lower than higher than expectations, which means it's not a very good number, they will have at the ready, I'll give you an example of what they did last week, unemployment benefits rose to 312,000. That's higher than expectations. What do they say right after it? Still close to 7-year low. They cannot allow that number to come out worse than expectations without editorializing in the first sentence and in the headline that somehow it's a good number. And as we've said, 300,000 people losing their jobs each and every week is not a good thing. And no matter how you look at it, they can compare it to historicals. What they're not realizing is even though fewer people are losing their jobs now than 7 years ago, that's from a labor force that's smaller after 7 years of devastation of that labor force.
Right.
And it doesn't translate into job growth. And maybe now, what do we have? This morning you're going to have the non-farm payroll number. Even if there's a big beat, so to speak, in the non-farm payroll number, you'll never hear the end of it. That'll be the sign that the skies have opened and, the water stops rising. That'll be the nirvana, and as you say, proof that somehow all this economic recovery is happening if that number comes in higher than expected. But, of course, even if it does, there'll be a bunch of part-time jobs in there and so on. But if it comes in lower, they'll still talk about the lingering effects of the weather. They'll talk about anomalies. They'll talk about it means that the next one's going to be better. There's no way that number will come in and will either have realistic data in it or be reported on in a rational manner.
Yeah, because you know what? Even if it's negative, they find a way to shrug it off anyway. Because what's going to happen is, it doesn't matter what we just saw there. Did you see what the ECB did yesterday? You know what I mean? Like
or this guy is not a traitor. He wasn't a traitor. He was actually a hero, and he was an undercover agent that was sent to infiltrate the Taliban. And he convinced everybody he was a traitor, but he really wasn't. Something like that, some kind of bombshell that we're all supposed to care about. You're absolutely right, Ryan. That little deal that they made was not on anyone's mind,
right?
Other than perhaps the parents of the guy. And to hear the president give a speech on it and saying, well, this is someone's son. Now he's personalized one individual when you've had, all the millions of people have been killed in the last 10 years in wars, and somehow this particular individual warrants this national attention.
Yep.
And you got people arguing on both sides over it like it's a major issue. It's comical in a way that's how easy it is to divert us from what actually is going on. Because no one even knew about that situation. Yep,
exactly. And you know what? It creates this, what do people get all, riled up about? Political issues, right? These things where they really want to take a stance. So if you just go on social media, look at Twitter, Facebook, people just don't care anything else about the economy because they can latch on to this for months.
You see the people, right, people talking about, if Bush did this or if Obama did that, and what about Ray? And everyone has a point of view over something that really has nothing to do with them.
Yep.
And it's not to impact, as you mentioned, your economy. Whether they traded 5 Taliban for 1 trader, 2 Taliban for, it doesn't matter to people. But they make it matter to you, and they make it personal. Now you've got a vested interest in defending the president or attacking the president.
Right.
I don't get involved in that.
No, I don't either. You know what? Then they want to get you glued to the TV so you watch their slanted views on everything, right? Because all you're going to get is 24/7 this on CNN and all the other stations. And all they effectively did was they created another sideshow, okay? They created a sideshow to take the light off of something else, and that's exactly what they're doing. And they've done it masterfully numerous other times. It's just people, they can't seem to wrap their arms around what's taking place. Which is interesting. One of the top hedge fund managers, I believe it was yesterday, Lewis, David Tepper, who's the founder of Appaloosa.
Oh, he's always going on. He's on the side of the media. Everything is wonderful.
But check this out. So he was very bearish on the outlook for U.S.
Oh, he's not. Yeah, that's right. He's not allowed back.
But now after yesterday, after what the ECB did, he basically came out and he said he's no longer fearful. He says basically that basically what happened with Europe and making them look, I guess, in a worse position. The U.S. looks a lot better, and he's no longer fearful. That's
the credibility. That was the credibility Baird talk that he needed to have to show that he's not always just rah-rah. Now, having gotten that out of the way, he can go back to being rah. Just like with the Fed when they do these credibility tapers.
Correct. But you know what? When you think about it, what David Tepper is really doing is he's just interpreting that the language from the ECB, and he's saying, okay, how will our Federal Reserve react to this, right? Because as long as they're going to keep their key Fed interest rate low, which they will, even if we unwind QE, now we have another buyer of our Treasury, so we're not really worried. The only thing is that this low interest rate environment is going to continue to force money back into the stock market because guess what? The people that do have money and that need their own fixed incomes, they're going to continue to drive money. I was talking to an agent the other day, Louis, an older agent, probably, I want to say 65 to 70 years old, and she was telling me, she starts out by basically saying, yeah, we just got to get this person out of the White House, and she's like, but you know what? I talked about the Fed manipulation of interest rates, and she's like, oh, no, I hope the Fed continues to do that because my stock portfolio is high. I said, you know what? I said, this is exactly the mentality of what people are paying attention to. All they're looking at is their stock portfolio, which I hate to tell you. I said, well, I hope that you're in some safe things because when it comes crashing down and you're at the age you're at, you're going to lose 3/4 of that. You're going to lose.
And the Fed won't have the firepower to fight it again. It's Ryan, you mentioned, the interest rates are low, and they've managed to find another way to keep them lower. If the ECB goes negative, funds will come into U.S. Treasuries, and that'll keep the Fed funds rate and the Fed interest rates low on the Treasuries, and interest rates will remain low around the world.
Correct. And you know what, Louis? You asked me last week, how long can this go on? When was it going to stop? Well, guess what? We've been doing this for 5 years. Don't think that the ECB won't do this for 5 to 10 years.
Oh, absolutely. They've just extended it because the real thing I thought was the end game was when the Fed ran out of QE, could no longer do QE anymore, would have to stop buying the bonds, the yields would necessarily rise because there would be no buyer. Well, now, when the ECB goes negative, there are buyers. Anybody who is thinking of putting money in the euro, in the ECB, as reserves, isn't going to do it. They're going to put them into U.S. Treasuries. And that's going to keep U.S. rates low. And European rates already low.
Yeah, and it's almost like, you remember before Yellen took her post as chair, she was basically, everybody had the view that she was potentially could take our interest rates negative, right?
Yeah, but she even said that she would be in favor of negative interest rates, but she won't be now. She doesn't need them to be negative. She needs them to be low and let Europe be negative, and that'll just keep ours low.
Exactly. And
higher on a relative basis, but still low enough for them to continue to bail out the banks and flood the market with liquidity.
And she can continue to taper because.
And she looks like she's a fiscal hawk now.
Exactly.
Because she's not printing money.
She's not printing money. They're very well positioned because it looks like the weather is behind us.
They don't have to raise interest rates now because they're high enough.
And you know what? It looks like manufacturing is coming back. The unemployment rate, which doesn't mean anything,
is down.
It is. The only problem is that we just haven't gotten inflation where we want it. That's the only problem that we have right
According to them, we need more CPI and more PPI.
Yeah, if we could get
not there yet.
If we could get inflation where we want it, Louis, we could get the.
That said, they've done everything. The unemployment rate has gone down below 6.5%, and therefore they can stop QE. They've gotten inflation at 2%. And see, they printed $4 trillion. Everything worked out. That's their story, and they're going to stick to it. What they've done is they set their goals. They've met them, even though their goals do not square with reality and do not square with helping the economy in any way, shape, or form. But if the media keeps telling us, look, they engineered a recovery, we're all supposed to clap like seals and say, these guys are geniuses. These 12 people know more than the entire market, and they've managed to centrally plan and produce a result for us. And we're now the model for Europe, because Europe is going to do the same thing.
Well, the funny thing is, Lewis, is that I had mentioned that, half the country makes less than $27,520. So the longer that we continue to do what we're doing here, as long as we continue to do this, that number is going to grow. And it's going to grow and grow and grow and grow until it's no longer 50%, it's 80%. Okay? Because this is the reality. The reality is that the rich are getting richer. The poor are getting poorer.
And it feeds into that Piketty guy's book that somehow there's something wrong with capitalism because don't you see this gulf between rich and poor is widening? Yeah, it's widening because of central planned economies and because governments through stimulus and central banks through money printing and negative interest rates funnel the money towards the top. It's got nothing to do with free markets and capitalism. So what it means is, if that's happening, we need more government intervention. So we need the government who created the problem and the central banks who created the problem to do more, to intervene more and control the economy even more to make sure that people don't get richer and other people don't get poorer. It's insanity.
Right. Yeah,
and it's interesting, isn't it? I haven't read the book, and I'm not going to. I might, but the Piketty book, why that becomes, an economic book becomes a bestseller and becomes the talking points on all the mainstream media.
Yep.
We haven't heard about people, we haven't heard that economic point of view before, that socialism works better, that wealth redistribution is a good thing, and that's a bestseller. And that's what everybody knows who this guy is, and he's on covers, and he's like a rock star now.
Yeah.
He hasn't said anything new.
Nope.
So why are they pushing, why is that being pushed out there? We're going to see that you would never see tomorrow a story on Ludwig von Mises.
No.
Or Murray Rothbard. He's like the new superstar of economics. He wants free trade and non-Fed intervention in the economy.
Correct. Yeah. And one of the other things, obviously the rate of home ownership in the United States has fallen for 8 years in a row, and it's dropped to basically the lowest level in 19 years. So let's just do the eye test, Lewis, just based upon that one
recovery
fact. With that one simple thing right there, with the interest rate levels that we have right now, we should actually have a booming economy.
Right.
It should absolutely be through the roof. There wouldn't be really any houses sitting on the market at all. There wouldn't be at all. Because you know what? We have so many jobs out there. They're just so plentiful that everybody's going to be making good money. They're going to be able to qualify for loans. And we all know the reality is that nobody's getting loans really these days. Now, the people that are, I would suggest, upper middle class, upper middle, and into the rich, obviously, because the rich can continue to buy up money. They can buy as many properties as they want. They have access to money that nobody else has. And it's really frustrating to me because I'm on the ground trying to help people. And, I am already starting to see, as I mentioned, that lending guidelines are loosening up, but it's not going to be fast enough. And it's still not fixing the main problem. The main problem is that even if you fix people's credits, you can't fix the job situation because you can't just go and say, hey, I got a job for you. Now you can buy a house. It's a little bit more. It's a little bit more complicated than that. Now, you can come to me and I can say, hey, if you do all this with your credit, and then you get a job and you come back to me in a year or so, then I can get you a house. I can help set that up. But the reality is that I don't have control over all these other things. I don't have control over rising healthcare costs and rising energy costs and food and all the other things that are out there. So the question back to how is your economy? I don't know, guys. You have to tell me. But I do know that it is irrelevant of all these numbers I've told you. This is just nationally what's taking place. Things are getting worse. Don't listen to whatever you hear anywhere else because it's getting worse. Now, who's it getting better for? It's getting better for the rich. It's going to continue to get better for the rich. And we'll continue going on this crazy circus ride that we've got going on with the ECB now putting negative interest rate environment. This would probably get us through Hillary Clinton's first term. Lewis?
Yes, and the Fed can cut the QE program, as they've said they were going to, when nobody thought they'd be able to.
Did you see the other interesting thing that Draghi came out with, which was similar to what kind of a program you and I were talking that the Fed might roll out, which was these long-term refinancing operations to the tune of about 400 billion euros, basically they would lend money to these banks at very low interest rates, but on the condition that they're lending that out to businesses, right?
Mm-hmm.
So they're coming up with some plans to try to get things moving, which is kind of what I suggested that the Fed should do, but they don't really want to do that because they don't want to lend to small business. They want to lend to big business and
right.
where there's all the malinvestment taking place and the backside deals. You know what I mean?
If they lent to small businesses, it would be based on criteria that had nothing to do with economics, but more on fairness and getting votes, like making sure you had a certain percentage of minority-owned businesses, a certain percentage of green energy. It would not be based on who would be most likely. And the government shouldn't be involved in that anyway, but even when they are, they take into account more political considerations than they do economic, because they're not equipped to figure out economics, and they shouldn't be in that game.
Correct. You know, I started thinking of, you know, Louis, we always talk about the eye test because that's what I do. I'm always paying attention to what people are telling me, what people are doing. So another client of mine, and I'll give some broad parameters here so people can get the context. This is a potential couple that's making over $200,000 plus. They already have an existing home that they have equity in. They could sell it and make a profit, and they're looking to move. Well, they've been looking to move now for probably 6 to 8 months, okay? They wanted single family, but they don't really feel pressure to move. And my big thing to them has always been, look, if you're able to capitalize on the low interest rates, it's important. Now, I can't control if they were all of a sudden spike up 0.5%, but at this point, I've had to tell them, well, look, I don't really see anything material changing between now and the next year. Now, granted, we get into a war or something like that could really shift interest rates, but they want to take advantage of the low interest rates right now, but guess what, Louis? They're taking their sweet little time. They don't feel rushed or anything, and they're going to wait for the perfect home to come along, and that could be a year from now. They've already been looking for 6 to 8 months. So even the people that are so well qualified and able to buy, they've got the down payment, they've got everything lined up, they don't even have to sell their other home. They can just rent it out because they still qualify for both mortgages.
Mm-hmm.
Those people aren't rushing to buy a house, which I find really interesting because I'm thinking, if this is me, I'm rushing to buy up as many houses as I possibly could probably right now. But the perception is, I think people are still a little uneasy about their overall feelings of the economy. And what I always hear come out of their mouth is, we're just really comfortable where we're at right now. We're just really
Well, yeah, you know what it is? If you have some kind of money, you're comfortable. If you have a lot of money, then you do whatever you want. But if you have no money, then you're uncomfortable.
Exactly.
It's pretty simple, and that's not a vibrant economy, because when people are in an uncomfortable situation, what they normally do is they try to arrange their lives and their economic circumstances to remove that unease, which usually means go out and try to get more money, get a better job, get a raise. Those opportunities aren't there, and you don't see that dynamism in the economy where people that don't have much money are in a position to try. You know, if you have more people on food stamps and more people on relief, they're not trying. Also, if you have people in the upper middle class saying, you know, I'm kind of good where I am, well, they're not creating any real economic activity either. And then you leave it, it's all down to waiting for the people with tremendous amounts of money to spend it on Gucci bags, that somehow that's going to drive the economy. No, it goes the other way around. You need to create incentives for the rest of the population to get involved in economic activity, not involved in how do they scrape by and collect benefits. Or if they have certain assets, how do they just preserve them? That's not a good economy. But they've created it where basically the best economic activity you can engage in is speculation.
Right.
And buying and flipping houses, buying social media stocks. That's where the money is. That doesn't produce jobs or a vibrant economy. But that's what QE and central planning does.
Well, and I gave that example of a well-qualified buyer. You know what? There's actually less of those, and I take more phone calls of people that have 580 credit scores that make $50,000 a year that want me to get them into a house with 100% financing at a low fixed rate, right?
Good luck.
Because, but that's that. You see, what's really interesting is those are the people that are really apt and ready to buy, but they have no stability. They're the ones that want to buy. The people that have stability are actually the ones that are more cautious and not really doing anything, which makes all the sense in the world when you start looking at these numbers, how the first-time home buyers are those people that are lower credit scores, higher debt, And then the people that have a lot more money are the rich, the cash buyers, 40% of the market. And the people that are in between, they're just like, you know what, well, we'll buy a house or we might not. I don't really know.
But the way to fix all this, Ryan, is not to take the person with the 500 credit score making $50,000 and try to push him into a home that he can't afford, is really to create an economy where things aren't as expensive. He doesn't have the amount of debt, has better job prospects, earns more money, saves more money, and can buy a house. But instead, the more we make it easier and bring the fences in to make it easier to hit home runs, the more expensive we're making and putting out of reach the ability of people to buy things without involving credit and help on credit. It's the same with the cars. Cars are at all-time high prices right now, and people are now paying close to $500 a month on average for a car payment.
That's not
the sign of a booming economy. That's a sign of a booming credit bubble.
Yeah, I mean,
it's the same, and they're doing it now with Freddie Mac and Fannie Mae. They want to lower the credit standards because we don't have enough home sales. They've driven prices higher. So instead of letting the home prices come down so people can qualify for them normally, under regular credit standards, they want to loosen the credit standards so people can afford to buy overpriced homes.
I feel like
they keep pushing it in the wrong direction, just like they're doing, Ryan, with the money printing and the negative interest rates. They're going they're going backwards in every way imaginable, literally and figuratively.
Well, it's like we mentioned, Lewis. They're running out of ammunition, right? The chains are
but they keep finding a stash somewhere. This negative interest rate thing is a stroke of genius because it takes all the heat off of the Fed and allows interest rates to stay low, and they won't rise now.
Which is why, me and you were always trying to figure out what's the next move, and we pay attention to these things. But when you ask me, how long can this go on? This can go on for a really long time. Unfortunately, much longer than you and I want it to, right?
But they are eroding the standard of living of people, even though they're coming out today saying that somehow people's net worth are higher than they were in 7 years. But if you go back, 20, 30, 40, 50 years, and you look at the average family, Welcome to Beaver. I don't know, what was the show? Leave It to Beaver. Families back then, you had one wage earner in a normal job, nothing spectacular. They owned their home outright. They didn't have credit card debt. They had 3 or 4 kids. The woman or the mother stayed at home. Some of them had housekeepers. And today, you've got 2 professionals in the family, male and female or same-sex couples, working, making money, and not having the same material wealth that you had 30 and 40 years ago. So, and they call the United States the wealthiest country on earth. It's not anymore.
No.
And there aren't, and that typical family that I spoke of, 2 wage earners, there's fewer and fewer of those types of units of wage earners. The household formation is down. Many of the potential wage earners are living at home with their parents. A third of people between 18 and 35 are living at home. Well, they're not out supporting, in 40 years ago, that one person would be supporting a family instead of being supported by a family.
Right.
And they'd be doing it on their own without the support of a spouse.
Right.
That's impossible today. You have to make $4,000 or $500 as a guy or a woman to support a full family and not have anyone. It doesn't happen anymore.
Yeah, because when
2 cars they used to have, right? 2 cars. People had 2 cars. They had a garage. They had a home that they owned. That was middle class.
Well, and you're seeing all these stories now. Of people that are paying for their health care for like a family of 4, and some of them are $1,500, $1,600, $1,700 a month. Right?
Yep. That's what I pay.
That's a mortgage payment right there. So
and then you got throw on a car payment of $500,
or maybe 2 car payments.
Okay, and then if you got student loan debt, how are you going to buy a house? You already you already have, and you haven't even eaten yet. You haven't watched cable TV. You haven't done anything yet, and you're already out a couple of $1,000.
Yeah, you have to basically, Lewis, you got to go borrow money from a rich relative, throw it in the stock market, and try to ride that up real quick to have to be able to have any sort of substantial down payment to put down. Then you got to go ask one of your rich relatives to get hired for a job as well.
I did speak to somebody who said they weren't working, and I said, "What are you doing?" And she mentioned that she was making money off of social media stocks, and I thought, this is 1999 all over again.
Well,
I mean, you're going to count. I mean, I don't know if she was counting on that being a permanent feature of her income, but that's what it seems like. I mean, if you keep interest rates low, there's really no place other than to put the money to put it into the stock market. And the question for you, Ryan, and for me becomes, at what point do you say, if this is the hand we've been given, if this is the way the world is, are you foolish to fight it? I mean, shouldn't we just go out and buy overpriced stocks that are going to go higher?
We absolutely should. I think as long as you play it to where you're hedging against that, right? To which if we're not financial advisors or anything like that, obviously, Lewis. So this is just our opinion. But if you were to take and still position yourself with a nice load of silver and gold to still protect yourself, right? Just in case things do crash. Now, we know that they can masterfully. I could almost see where the stock market could actually fall, but we still wouldn't have a huge increase in gold and silver. We've seen that before, right?
Well, the negative rates should have driven gold and silver up massively yesterday, because generally the price of gold trades off of the difference between real interest rates. It makes no sense that you're going to have negative interest rates and that gold, goes up $6 or $7 yesterday.
Yeah, and I mean, it's the same thing with the real estate, right, Lewis? I mean, there's the price appreciation that's taking place and low interest rate environment. So I like I said, I'm still actively buying real estate. I'm still, I invest in the markets, just not as much, because I stick with what I know, right?
Right.
I stick with what I know for the most part, and so I can I consider myself conservative because I can control my own destiny with sticking with what I know. Now, because if I go entering in the stock market, it's always like, okay, well, am I getting in too late? Now, if you're buying all the time and buying at different price points, then I would imagine, yeah, you're probably going to make out okay. But, yeah, I do agree, and I think that's pretty much what everybody's saying at this point, Lewis. It's like, well, it kept going up. Everybody said it was going to come down, but it keeps going higher and higher and higher. And they
have endless tricks to keep it to make it go higher.
Yeah, I mean, it really is amazing.
They have engineered low interest rates, and they'll do whatever it takes to engineer them. And when they start to go up, then the ECB will engage in QE. They've said that they're ready to do that if they have to.
Well, and all of this is very destructive long term. I mean, I talk
totally.
about there's never ever been a fiat currency that hasn't become extinct at some point. The dollar will become extinct at some point, because what's taking place is just it's crazy. Now,
no, wait, hold on. But the thing about the dollar, though, it just gains strength because they're going to stop printing money. Forget that they printed $4 trillion. It's the euro that's in danger, but the euro is starting at a much higher plateau now. It's overvalued compared to the dollar. So they've got room to debase. As long as all the central banks are playing the same game, none of them will go extinct, because they're all dead man walking.
Yeah, exactly. Well, you're right, because the ECB goes on QE, we come off, and then the ECB gets stronger, and then we get weaker, we go back on, right?
Exactly.
It can be
as long as people believe in the whole fiat currency system, none of them will die. As long as they all play nice, it's just like that. What used to happen with the gold standard gold would flow back and forth amongst countries depending on how well they were doing. Well, now it's to say how well the flows of money printing or QE will go back and forth according to how well the countries are doing. So when the U.S. did QE for a while, lowered interest rates, they stopped doing it. Then Europe starts. They lower interest rates. Then after a while, then they do QE. As you mentioned, then it's the United States' turn. If they all play together, there'll just be this back and forth and ebb and flow of QE and money printing and interest rates rising but never rising too high, and then lowering again. And they can engineer this and keep interest rates close to where they are. There's no market anymore. It's central bank coordination.
Which is that's exactly what it is. And And, for everything to take place like almost as seamless as it has, the way these economic reports have come out, and then the way now the ECB has gone into negative interest rates, and how Belgium's been buying our treasuries and we have a low interest rate environment despite where, we know that interest rates really should be at this point, and they're not. This could go.
And they're not going now because of the European central banks' negative interest rates. Our rates aren't going to rise that much.
We could actually see our rates go back down, Louis.
Correct.
So,
and even though the Fed will remove the entire $1 trillion a year stimulus.
So, as long as you have a low interest rate environment and a high stock market, right? So the consumer sentiment is going to be relatively high, regardless of whether 50% of Americans are making $27,000 or less, right? Because the media doesn't ever talk about those people. That news isn't put out there, so nobody really cares. They could be making nothing, but I guess as long as everybody else's stocks are doing well, then everything is just peachy. So,
yep.
I think that you are right. I think that this can go on inevitably for a very, very.
I was predicting the end of it because once QE ended, I didn't see a way out. I didn't see another buyer. Well, buyers are there now. There's actually market buyers now. Forget even any kind of manipulation between central banks. If the US Treasuries pay something on a higher rate than Europe on a much higher rate, the money will flow into US Treasuries.
So, looks like we're pretty much screwed then, because it's just going to be much of the same, right? I mean, it's going to be these ebbs and flows that could go on for 10, 20 years.
Sure. I mean, it depends on, for them, they need to control the monetary system, and the only way they can do it is doing what they do. They can't allow the market to overwhelm them. They have to be the market. They have to manipulate the markets. And when necessary, they have to coordinate with the other central banks. And given that the biggest blocks are Europe, Japan, United States, they can do it. And as we've always mentioned, the only thing that's going to screw that up would be China and Russia or the BRICS somehow coming up with an alternative system that's based more on actual value and sound money. Otherwise, there is no alternative, and they can continue doing what they've been doing and manipulating the interest rates and manipulating the economy. And they can hold asset prices up, and they can use all of the money that they have to manipulate the other markets, like the gold market, the silver market, whatever market they need to manipulate, because they're awash with paper, dollars, euros, and so on to do so. And when you can naked short sell things, you can control the physical markets very easily.
Go
ahead.
No, as long as we keep our government system the way it is, where everybody is basically dependent upon the government, this socialist government essentially, where
Correct.
You're relying on the government to feed yourself through food stamps and all the other programs that are out there that are
and to get you a house, to help you qualify for a house, qualify for student loans.
Yep. Keep you just enough to keep you at bay, right?
In debt, so that you can't go anywhere.
Yeah, I mean it really is. I mean, as we sit here and talk through this podcast, Louis, I mean, as it's kind of evolved over the last 3-4 years, and every time that we think something could happen, it's a masterful sideshow that takes place, right? It's the ECB stepping in. There's always going to be something, and it's funny because people are always like, oh, well, wait till the next election, and I'm like, are you blind? Because it really doesn't matter about the next election. Really.
Especially the president. The only way you'd ever have real change is if you had. It's not going to start at the top with the presidential election. It would have to start with some type of third party running in all the local elections, and the amount of effort and time and resistance you would get from that. And first of all, people would have to agree on what that third party looks like, and you never get that. There's no way you're going to get a change through. It's going to have to come through economics. It's not going to come through politics, because politics is owned by the current economic structure.
Yeah, and the media is controlled by politics.
Oh, absolutely.
So
you're not going to hear anything. Nothing's going to happen. So that's why I was saying earlier, is you just play along with put your money in the stock market.
Well, I think that
that's what they want you to do.
That's what they
and
want.
They reward you for doing it.
I think that, I don't really think you have a choice, because if you and I sit here and do a podcast for the next 10 years, Louis, and they continue to come up with just, these crazy policies and who knows, probably backroom deals and everything else they got going on. Yeah, there's who's to say that they can't continue.
We were right up to 2011, and then the last, since 12, 13, 14, they've managed to patch this thing together and actually, strengthen the adhesive tape and make it stronger.
And regardless,
even though it's underlying, it's weaker, but they've managed to grow the edifice. And
regardless of whether a ton of houses are really selling or any of the economic data that comes out, they will make it seem as though everything is fine and it's moving in the right direction, even when it's not. So who really cares, right? So it's like you might as well just jump on board and go for the ride, right?
Yeah, I just saw something come out here on Fed's Powell. Labor market has recovered substantially. Federal Reserve Governor Jerome Powell said on Friday the U.S. labor market has recovered substantially. Oh, where did they come up with this? And he cites the unemployment rate being 6.3%.
Well, I think that maybe it's just me and you are the only crazy ones out there.
I don't know. That's their job. I mean, they have to say they've done a good job, and now they're taking a victory lap. Everything's recovered. They just need more inflation. They've got the unemployment down. Everything is going fine. Housing prices are up. Economy's going to accelerate in the third and fourth quarters. Stock market is up. Look at Europe. They're the basket case. We've done our job, so let's end the QE.
Well, wait till all the farms in the Midwest experience a drought, right?
Well, they won't blame see, then they can blame the weather again. I mean, because the food prices went up not because of anything the Fed did or because it's because of the weather.
Right. I mean,
but we can have bad weather for 10 years. I mean that. And they'll start talking about it. It'll be climate change, and there'll be another reason to have to get the Fed and the government involved buying carbon tax bonds or something.
The fact that they even bring up the weather is a joke, right?
Of course it is. That's why they should be comedians instead of weathermen.
And, well, I mean, I think that it has turned into a bit of a comedy just all the way around. But
no one's laughing. People take them seriously.
Well, and if somebody listened to our podcast, and they would probably say that, oh, what are they talking about? Don't they see that where the stock market's at? Right? I mean, because that's what they hang their hats on. That's what everybody can point to is that, well, it must be working. Whatever they're doing is working because if it
saved us from the Great Depression.
Absolutely, and more to the
you and I would be walking around with a hat in our hand in a soup kitchen. So would everyone else if the Fed did not save the economy, not realizing they caused the whole thing in the first place.
Right. And, and more to the point, and in the show, the same way we started it, the rich get richer, the poor get poorer, or, everybody pretty much seems in the same stagnant place. Yeah, your stock portfolio is going a little bit higher, but financially we have no inflation.
How long can you count on your stock portfolio? It's not like it's a consistent money earner. They aren't stocks that are dividend producing. They're stocks that are just being boosted higher. And in fact, I did a blog post on this, Ryan. Stock prices have been boosted by the number one buyer of stocks, which are the S&P companies themselves, who bought $160 billion worth of their own stocks in the first quarter, being the largest buyer. Not a hedge fund or any institution buying. It's the companies themselves. And where are they getting the money? They're not reinvesting their own cash back into their businesses to grow their business. They're putting it back into the company to grow their stock price.
You know why? Because their businesses aren't making any money.
No, and there's no growth potential, but there's growth potential in the stock. So they either borrow money at low rates or they use their existing cash to buy their own shares. That's a farce.
Absolutely.
And when they say the stock market's doing well, you have to ask, why is it doing well? The companies aren't growing their revenues. In fact, you talked about last week the sales of all the major retailers are down, yet the profits aren't down as much, which means they're not passing along their cost. And then there was a show on, I forgot which channel, but there was a show that showed how all of the food companies, and there was an article in Motley Fool, about how the food companies are reducing the size of their packages from 16 ounces to 12 ounces, or worse, leaving the size of the package the same and just putting less in it and not changing the number on the package from 16 ounces to 12 ounces and charging the same price. So you tell me there's no inflation.
Right. Well,
they've already done that. And to do that is a major undertaking, Ryan, because it costs a lot of money to change all your packaging.
Absolutely.
And to change the sizes. So that means it's worth it to them to do it.
Well, and back to the question, how is your economy? Well, I don't know. You guys are the only ones that could answer that, and for everybody it's different. But you are probably going to be paying more for your food and getting less of it. Your wages are probably stagnating, if not going down. If not, you might be losing your job.
And you're going to ask the Fed to get you more inflation, though, while you're in that position.
The reality is, though, guys, is unfortunately the Fed is not an unlimited bankroll for the average consumer, right? They only take care of their own. They only take care of the big banks and and the rich are getting richer. And at the end of the day, though, like I said, it's what your economy is. If you're in a good position, if you have the means to buy a house, if you have the means to take advantage of low interest rate environment, then by all means do so.
Yep.
I would not really worry about necessarily what's going on around you, because as you said, it's basically we might as well turn a blind eye to it as well, Lewis, and just go along for the ride, because apparently they have enough a masterful plan in place that can allow this to go on for years to come. So knowing that, look at your situation. I just always recommend that just don't pay attention to the media headlines, because it doesn't do you any good. But if you are curious to know what's going on, you don't have to look any further. Well, our podcast for one, but mainstream media is probably not the best place to get your information.
Ryan, we just got the non-farm payroll, and you nailed it exactly. Expectation was 215,000 jobs. They created 217.
Oh, there it is.
Which is no big deal. That's not very many jobs being created when you're losing 300,000 a week. However, we're going to see the unemployment rate down to 6.3%. And that's what's going to be the headline, that they beat expectations and the unemployment rate continues to fall. Here's AP. Fourth month of solid gains.
Yep. And guess what, Lewis? That just brought us to the end of 2014. Because all we need is really one. We have the ECB doing that, and now we have this right behind it. It's enough. It's enough to get us to the end of the year before anybody even cares about what's going on. I mean, it's comical, but like I said, you can almost predict where these reports are going to come in before they do. And
manufacturing and construction is only 16,000 jobs. But I won't focus on that, though.
No, it's not important.
It's not important that we have growth in productive sectors of the economy that produce goods. No, it's more important that we hired more bartenders or more in the services sectors. But that's the headline, Ryan. And you're right. This is all good news. It's further evidence of a solid and recovering labor market and a recovering economy.
Absolutely. So, Lois, we're coming up on the end of the show. But as I suggested, everyone, evaluate how your economy is doing. Leave us a note at Real Estate 360 Live on the Ask a Question button on the right-hand side. I'd love to have your comments, any feedback, any topics that you'd like to see us discuss in future episodes. Lewis, appreciate you coming on. If you give our listeners your blog so they can check that out, I greatly appreciate that.
Oh, sure. Thanks, Ryan. It's at smallgold.com, SMAULGLD. You can check that out. There's a blog post up there every few days on the economy, real estate, gold, silver analysis, and also YouTube versions of the podcast. So check that out at smallgold.com.
Awesome. Thanks, Lewis. Appreciate it.
Thanks, Ryan.
Thanks, guys. Feel free to download, subscribe, share, search on iTunes, Real Estate 360. Until next time, take care.